Honest facts, dynamic conversations, and powerful financial strategies that will help you craft a blueprint for your future. Welcome to We Money Talk with the founder and CEO of We Alliance Wealth Advisors, Terry Wheeler.
When you plan for retirement, you may hear the term fixed income and specifically bonds. I'm Patrice Sikora with Terry Wheeler, your host, and Terry's got a guest with him today, Matt Williams. Terry, Let's start with the question about bonds. Are they the only fixed income option out there?
Absolutely not. I think bonds, we've all heard of the 60-40 stock bond portfolio. That's not how institutions invest at all. That's not how individuals should invest. So you got to go with fixed income beyond just bonds. So there's index crediting strategies. There's Matt is joining us because we're going to talk about real estate lending strategies. And these are just a few of the fixed income strategies that make up a proper portfolio.
All right. So let's start with bonds. How do you view them and where do they fit? Do they fit?
Yeah, I think bonds absolutely fit. Became a 60-40 portfolio for a reason. Bonds are a mainstay in fixed income, but you've got to look at where we are in the market environment. So bonds aren't always good. There are times where you should have next to zero bonds. And give you an example, interest rates hit zero a few years back. So when interest rates go up, you have bond values going down. When interest rates go down, bond values go up. So when interest rates hit zero, bond values had nowhere to go but down. So when you look at some of the funds by Vanguard or Fidelity and go back to 2018, just Google what have they given you in total return since then, and you see you've earned next to nothing over the last 6 years. So bond funds in particular, you got to be very, very careful of in certain interest rate environments. So we're not big fans at all of bond funds. But bonds themselves can be used outside of funds effectively in a variety of environments.
Yeah, I was going to go to the bond mutual funds, but obviously you're not crazy about them, huh?
I'm very, I'm not against a lot of things, but I just don't think bond funds have much of a place. I think bond funds, I guess that's not completely true. Let's say we're at historically high interest rates. So now you know that probably rates are going to be coming down for a long time, which is the last 20 years have been decreasing interest rates up until recently. Bond funds could do okay for you at that time. But for the most part, you're better off buying individual bonds. So we call it defined outcome bond investing. Now, what do I mean by that? All I mean is you buy a bond and it's yielding 6% and it's going to mature in December of 2025. It's going to go maybe up and down in value between now and December 2025. But if you hold it till December 2025, you're going to make exactly 6%. So as long as your issuer is quality and they're not going to go bankrupt, you're going to get exactly what you bargained for. So you can work with that effectively in a portfolio. Whereas in a mutual fund, if it goes down, other people are selling and you're getting losses because they didn't hold it to maturity. So you're affected too much by other people. So defined duration bond investing can work in any environment, but you shorten up durations when rates are very low. And then if you have longer durations, I think it was back in 2020, thereabouts, you had interest rates where you could get some treasuries that were high yielding. So if you locked it in for 30 years, it would have been a great decision. So you got to just pay attention to the interest rate environment.
Yeah, who knew, right? Right. How about some bond alternatives? You talked about those a little bit.
Yeah, so we have a variety. One of them that we like to do that's more akin to a bond is a fixed income strategy that is based on index crediting. Now, index crediting is something familiar to most of us, and it's familiar more in the term of we're all familiar with indexes like the S&P 500, the NASDAQ, Dow Jones Industrial Average. So we see them on the news every night if you watch the news and you're watching the business section. So they're pretty common, but there's over 250 indexes. And of those indexes, we work with a variety of groups, but one of our favorites is a group called a Nexus. And Annexus is really a big innovator in the retirement industry, and they've chosen indexes that they can do index crediting strategies that will allow you to get the upside of the market but protect on the downside. So we often tell investors we want to first of all protect your principal and then get a return on your principal. So return of principal first, then return on principal. These strategies, most of them you can't lose money on. So the indexing strategies that are innovative can be very powerful competitors to bonds. And at our firm, we think that they're going to perform quite well in relation to bonds over the next 10 years. They definitely backtest far better than bonds.
Okay. All right. You mentioned a Nexus. What are some of the indexes in there that you seem to like that in your opinion do well?
Sure. So there's several. One of them that we kind of started with was by a gentleman by the name of Dr. Robert Schiller. He wrote a book called Irrational Exuberance. He's got another book sitting on my desk that I haven't read yet that's talking about market bubbles and why they are created and why they pop. But he's everywhere in the financial industry. So he's credited with a variety of tools that people use to value the stock market. But his indexing strategy that was exclusive with Annexus and exclusive in Annexus products is called the Cape-Shiller Index. And this one is one that he basically looked at market sectors. And when you look at the business cycle, it kind of rotates. So the business cycle is hard to predict where we are in the cycle or how long a given phase of the business cycle is going to last, but it's a pretty predictable pattern. Meaning you go through a business cycle, expansion and contraction, and different sectors will do better at different phases of that cycle. So what he did is he basically tried to identify the 4 next cycles that are going to perform best, or the 4 next sectors. And instead of investing in all 11, he would just invest in those. And he found that he could consistently beat the S&P over the long run. That was his theory, and his index performed just that way. So I mean, he was able to do quite well. So these are great strategies, but we look at them squarely as bond alternatives. And unfortunately, the industry sometimes sells them as stock alternatives, and we think that is just in our opinion, it's a flat out wrong way to go, but it's a great bond alternative.
All right. Well, why don't you introduce Matt to us?
Yeah, let me hit on one last section first.
Oh, sure. Go ahead.
This is on the index thing because we want to cover kind of the problem. Now, with the index crediting strategies, you can do back testing. So the California Department of Insurance allows illustrations that will show returns that can be in the double digits. And they are right now based on today's credit ratings. You backtest them over rolling 10 and 20-year periods. Many of them will be in the high single digits and even into the mid double digits. Now, what I wanted to hit on from a backtesting, because we see this everywhere, meaning we see advisors running with this because they illustrate so well, is backtesting is not what anybody ever made. So when you look at these returns, they're based on today's credit ratings. So the amount of the index you get. So you might have an index that you're getting 200 or 300% of whatever it does. So let's take the Loomis Sales Index as an example. It's one of the Annexus indexes that we love. It's designed with a target of making about 6% in up and down markets. Now, 6% isn't exciting to most people. It's not exciting to me. But if you can get 200, 250% of that index, now that 6 becomes a 12 or 15. Now, when you look at back testing, that's exactly what you're going to see during some of these 10-year periods. Now, you're able to illustrate it, show it to a client on an illustration. So why am I saying it's bad? Well, the reason we're saying it's bad is because these backtesting indexes are based on the current interest rate environment, and the interest rate environment is historically low. So when interest rates change, it's going to change that backtesting dramatically. And we find that clients don't care what they may have, could have, would have, should have earned in the past 10 or 20 years. They care about what they're going to make the next 10 years. So we want to set realistic expectations. So we position this as a 6 to 8% bond as our target. If we get a 5, we're probably keeping up with treasuries. But if we can do better than that, then we see it as a success. And if they can deliver the double-digit returns that their backtesting shows, we'd be thrilled. But ultimately, I think you need to temper expectations, and bond allocations is where these fit very well. But I wouldn't use them as a stock alternative.
Not exuberant.
Yeah, you just have to temper things because the future, these product companies try to sell products. We're in the business of trying to advise clients to make the right decisions for the right reasons. And that means you've got to really look at how something is built and what the flaws are. And these are great investments in our opinion, but they're not stock investments. They are bond alternatives in our view.
Got it. All right. Now introduce us to Matt.
Sorry. So Matt is our lead underwriter. He works with me hand in hand to manage some of our debt strategies. So with real estate debt. And we find real estate debt is a great way to get good income, especially when interest rates were down near zero. We were getting great yields. So I'm going to maybe kind of interview Matt a little bit and ask him some questions to enlighten our listeners as to some of the opportunities there. So one of the things we always talk about in lending, just to kind of start at the beginning, is loan to value. So Matt, can you just tell our listeners kind of what do we mean by loan to value and why that's important?
Yes, I will get to our favorite three little letters, LTV. I just want to thank you for having me on this morning. Excited to be on We Money Talk. So getting back to loan to value, it's probably one of the first and foremost things that come up when you get into lending. You'll see when people go buy a house, you used to hear, oh, you need a 20% down payment and you would get, and then the mortgage would be 80%. That was where your loan to value is how much the mortgage is to the value of the property. So in this case, you buy a $1 million house, you have an 80% loan to value. The mortgage is for $800,000. The borrower puts in the 20% down payment to purchase the house. So it's pretty simple math. That's how it goes about. But in lending, why it's so important is it gives you the protection of what happens to the property value. For as the mortgage holder, whether it is a private fund or it's a bank who makes the loan, they have a cushion to see what happens to the real estate market on the value of that house. We all remember what happened back in 2007, between 2007, 8, and 9, when we had probably the largest real estate market drop in most of our lifetimes. You saw what happened. And a lot of reasons back then, too, is people were not putting down a large down payment. They were getting 90% loan to value, 95% loan to value. And then you saw when the value of real estate dropped, you saw what happened to people. Unfortunately,
I remember Matt in San Francisco. There was a story of a waitress, I believe, that had bought, I don't know how many houses with basically almost nothing down. So if you're lending at that level, that doesn't sound like something I'd want to invest in.
No, definitely not something I would want to invest in either. And probably most investors out there who want to invest in real estate. That's why, we first and foremost, we look at that LTV number, and I'll give you some examples. There's a couple different strategies that a lot of funds do out there. And I know this is what we do. We have a preferred strategy, which gives you a lot of extra protection with a lot of more loan to value, because we give that one a 30% loan to value, which means they're a preferred share class and they have a 30% loan to value towards that property or towards all the properties together. And give you an example, the real estate market has never dropped over 70% in any of our lifetimes, majority of our lifetimes. I think the last time it happened was during the Great Depression.
Yeah.
So that was almost 95 years ago. So even at the most recent one back in 2000, 2008, again, like you saw 30% drops. You saw a few in select areas. You might have saw up to 40%, but it's never been anywhere close to 70%.
Yeah,
That's why we like those preferred.
I think San Francisco homes dropped almost 45% during that. So we say that left and right coasts are a little bit more volatile. So some strategies in lending is to go into more stable areas which you can identify. But just to be clear, Matt, when you say that your preferred strategies are at 30% loan to value, that means real estate has to drop 70% before you lose your first dollar. Is that right?
Yes, correct.
Yeah. So that's a healthy level of protection.
Yes, especially when you're using it for one of your fixed income approaches and part of your overall portfolio.
So you can't be making much money with that much safety, can you?
Well, you still can make pretty good money. It's not going to be as high as I'll talk about. The next one is just our secured income strategy. It's not going to be as high as that, but it's still pretty good out there. I definitely would think about it and use it if it's something you were interested in. If you like investing in real estate, like the next example is our secured income strategies, which is very common. There's a lot of companies out there doing it. But in this case, we look for a maximum of 70% loan to value. So again, out there, we're making loans on the property. We're giving it a 70% value of the property. And that gives us the borrower in that case has to have the 30% down payment or 30% into the property. And again, it gives us the cushion of having that 30% leeway. Now, our 70 is our max. A lot of times you'll see we're in the 65 or less percent loan to value range on those secured income strategies. Now, those, again, since it is a higher loan to value, it could be a little more, risky if something happens to the real estate market. But again, it is paying more than on the preferred security side.
Yeah, and to give people context there, in the 2008, 9, and 10, something called the NACRAFE index dropped right around that 30% level. Now, because you have income coming in, it actually was only down on a total return basis by less than 25%. But what the NACRAFE index covers is it's going to be apartment complexes, it's going to be commercial properties, it's going to be industrial. It's basically commercial properties excluding single family homes. So single family homes are not a part of that. But this was the worst real estate market that anybody here has lived through for most listeners. And I say most because Gabe's grandmother, who we talked about this morning in a conversation, is turning 105. So she lived through the Great Depression. And the Great Depression was worse than that. So you are going to have losses if you have a Great Depression type thing. But being able to survive a 2008, 9, 10 with 70% loan to value should allow you tremendous protection. And this is in relation to other investments. So if you think back to 2008, a lot of us have stocks in our portfolio. Stock market was down 55%. Now, banks were failing after a 30% drop in real estate. Well, you're losing your first dollar if you're at that point. So if you're down 10% and the market's down 55, that's not a bad return, especially knowing that you may have to take back real estate that we know with the benefit of hindsight, it rebounded and you would have made a ridiculous amount of money. So the key with real estate, we call it one of our defined outcome strategies when you talk about lending. So similar to the defined bond strategy, with real estate lending, we know what the negative is. The negative is we're going to be able to take back a property that we would love to own at 70 cents on the dollar. And actually, most of our lending is more in the 60 to 65%, and several loans are in the 50%. So 70 is just the high end. So ultimately, the defined outcome allows you to analyze the properties as if you were an owner. So Matt, can you talk a little bit about that underwriting and kind of what it might look like if you had to take back a property from an income standpoint?
Yes, and that's what I want to talk about too. Is the first thing is one of the first things we look at is an income producing property, meaning like obviously a multi-family or even a single family or an industrial commercial where it's going to be getting rented every month and you're going to be getting that income coming in. So if the value of the property was to drop, you're still getting your monthly rent payments that will come in there and continue to give you the fixed income investment, from that side. Now, underwriting, that's my background and that's what I do on a daily basis. I kind of call it like it's an investigation of the property. First and foremost, I look at the property, I look at the location. Everybody, when you hear about real estate, it's location, location, location.
Okay.
Obviously, that is one of the most important things, but also where's the property in relation to everything else around it? Is it going to be a good rental property? Are people going to want to live there? Is it in the neighborhood that people want to live if we're looking at a multifamily or a single family property? And again, what kind of rent is it getting? Is it getting, is the rent enough to cover all your expenses every month? Expenses, you would have taxes, you have insurance, you have maybe gardener to do the yard, especially if you have a big multifamily, you even have a lot more expenses on top of that. You got property management. So is the amount of money coming in to cover those costs and also give you a return on your money? So that is what we look at when we start underwriting property. That's just a quick little view of it. It's a lot more detail and takes a lot more time, but those are the main factors we look in. Is it going to be able to produce a steady monthly income over and beyond what all the expenses are? And if it does, it makes sense, and that's something we want to lend on. And if it doesn't, we'll just pass on and move on to another property. And one thing now, it's nice. In the last couple of years, I think everybody's been knowing what's been going on with mortgages and banks, and the mortgage banks have slowed down their lending, which is great for us because that's given us opportunity to come in and fill the void that banks have left because they're not lending on properties right now. Because the way the economy is, banks have tightened up their lending boxes. They aren't as interested in lending money as they used to. So that is great for us and gives us a lot more opportunity that we're excited about. One last thing, I know we talked about a lot of the secured income strategies. We have another opportunity which we call
actually, Matt, let's back up 1 second though. So for the secured income, because this is a key point for why we lend and how we lend. When we underwrite a property, we know what the income is. I mean, we get the rent rolls. So we know what the yield will be when we take back a property. So we're talking about fixed income alternatives. So we know we get great yield on the loans. So that's a given. Those are going to be much better than bonds typically. And it's going to give us a really nice, what we call real rate of return over and above inflation. So a lot of these loans that we're underwriting now, we're getting double-digit returns, and some of them are really what we call bridge loans. Now, bridge loans it could be a property that they have 50% equity. They just need a loan because it's taken forever to get something through the bank. So we provide that gap loan, so to speak, so that they can get better, cheaper financing, but they have to pay us more. But when we're underwriting, when you do what's called asset-based lending, which is our approach, you know that if I have to take back this property, I can calculate what's called a cap rate. Now, a cap rate is nothing more than how much am I going to earn net of expenses if I just pay cash for a property. So I can go in saying, okay, my defined outcome, if things go bad and I have to take this back, I'm going to have some legal fees. I'm going to have some interruption of income for a period of time. But I can go in knowing that I'm going to make 8% or 9% or 10% on this property while I hold it. Now, why that's important, why that is important is because when real estate markets go down, at least traditionally, they come back up. So if you had to take back properties in 2009 or 10, you did incredibly well. Your cash flow was really good. I bought, I think, 4 or 5 properties at that time, and nothing cash flowed under 10% a year net of all my expenses. And all of those, because I only put 20% down in my case, all of those are up several 100% before I sold them. And a couple of them I still have. So with real estate, people build wealth in the United States overwhelmingly by real estate and businesses. It's not by buying stocks and bonds. It's real estate and businesses. That's over 80% of the wealth created in the US. So if you're lending and you have to take back a property at 60 cents on the dollar, and you can cash flow well, so you're being paid to wait, that is why I love real estate lending so much, is great cash flow if things go well. And if things go bad, it's pretty darn good and could even be a bigger return. So when Matt underwrites things, we know going in, this is the return we're likely to see if things go bad and we take it back. So we already know the downside. Now compare that to the stock market. Stock market, is it going to go down 30%? Is it going to go down 50%? Is it going to be like the tech sector, which went down almost 80% in 2001, 2, and 3? So it's a matter of having a defined outcome. We know the path of how we are going to recover if things go bad. And to me, that's one of the most important lessons in investing, not just in real estate, but in any area, is you've got to address the downside. It's not all about the upside. You got to have a good defense. So sorry for interrupting you, but that's the biggest reason why I love secure income is I know what I'm looking at if things go bad. And that's what makes it so powerful. And then go to the exciting opportunity that you're going to talk about next, which I want to talk about too. But I just wanted to get the secure income side down first because that's more conservative. And now this is really one of the areas we're most excited about.
And then again, like as long as you're in an income producing property, even if the real estate market does go down, you're still getting your monthly checks, for the monthly rent payments that's being made. Now last one I want to talk about is another or fund that we that we use to invest in. It's more of a opportunistic, we call it the distressed debt, where this one, like we talked about having a income producing property like this one, or looks for properties that obviously not need a lot of rehab, a lot of remodel, can use, a lot of work. That's why we like to call these sweat equity properties, where they might not be producing income as soon as you get them. Once you put in all the sweat equity, you finish the rehab, the remodel, it will produce the income that we're looking for in properties that we usually lend on. And lastly, usually it could be an underperforming or a non-performing property, whether it's a non-performing loan. And then once you get it ready to go, you get it all fixed up, it again usually has a higher upside. And that's why we like to call it the opportunistic side. And usually those, again, could take a few months, anywhere from 1 month to 6 months to even longer if it's a larger project. But again, you get that sweat equity, and that's where you earn that extra money that can pay off in the long run.
Yeah, and the sweat equity comes in debt in two fashions. So normal real estate investing, when you're talking about sweat equity, you're talking about flipping houses, apartment complexes, properties, meaning you're taking something that people didn't have the money to do the proper upkeep, and you're upgrading everything, raising rents, and increasing both the value and the cash flow. So that's one form of sweat equity. In the lending, part of what Matt's referring to is we will buy debt that is not so attractive right now because maybe they're not paying. So that maybe the bank is trying to get rid of it because it's a non-performing asset. Or one of our favorites is actually a mistake that turned into one of the best investments we've ever made. And that was January of 2020. We had done all the due diligence on hotels and hotel debt. Well, we made a loan at 60% loan to value, basket of loans, actually, Marriott's high quality properties. And about 45 days later, the pandemic broke out. So 60% loan to value was supposed to protect us based on all of history. Pandemic breaks out, and now nobody can pay. And these are high quality operators, great properties, not high risk by any means, but nobody could pay. Nobody was going to hotels. So we had to do what's called workouts. So we had to work on those loans with our institutional partner. We raised the interest rates. We put interest on the back end. They're going to end up all being double-digit returns, mid to high double-digit returns as far as into the teens. They're all being refinanced over the next 12 to 18 months. But the story here isn't about those first loans. Those first loans protected us. We haven't lost a dollar. They're performing great. So the 60% loan to value protected us even during a pandemic. But we did have interruption of income. But what we did next is what I'm so proud of. And that is we had done the homework on hotels. We knew 60% loan to value should protect us over most market circumstances, but we had never been through a pandemic. But then we did the research on pandemics, and they run their course. That's how it happens. You had to go all the way back to the 1890s. So we started buying up debt with our institutional partners from banks who had to get rid of it because they don't like non-performing assets on their ledger because they can't multiply money. And back then, if you don't know what was happening, the government was giving banks money almost literally. So they would give them money for no interest, and then they would pay them 2%. That's just handing them money. But you can't do that on non-performing assets. So they had to sell them, and they sell them at a very nice discount. Now, we had done our homework already, so we bought up a lot of hotel debt during that time. So that's an example of a distressed opportunity that really you're buying an asset that is high quality. You know that you're going to have some risks that aren't typically there in normal lending. The primary risk is time and interruption of income. So some of this money, it can't be money that you need income today, because it could take 6 months, 12 months, 18 months to get things back on track if you have to go through a foreclosure. But workouts are much faster, and that's what happens with most of these. So these opportunities can be phenomenal. Go ahead, Patrice.
Well, while you guys were all talking, I kept thinking of The Big Short, the movie. It kept going through my head again and again. But you need to do something now called the COVID Hotel.
Yeah, and all these people, like, again, these are some of the bank's best clients. They didn't want people that would foreclose on them. They wanted people that would do workouts and that would get them through what was a terrible time. So we're not predatory lenders, at least at our firm. There are firms out there like that. We don't try to squeeze out every dollar. If you have a good operator that is in a bad situation, you work with them to give them a path to success. You don't try to take their properties, and that's just not a way I want to make a living. I want to take a property back if it's a bad operator, they're doing wrong things or treating their home like an ATM or something like that. But good operators, you just work with them and you can find win-win solutions.
Absolutely.
Yes, that's the approach we like to take.
This has been great. Is there anything we haven't touched on that you guys think you really want to?
I would just say, well, anything real estate wise you want to hit on, Matt, before we, because I'm going to go general.
You know what? I mean, I know that was a pretty brief and quick kind of summary of why we like lending as a fixed income approach. But definitely turn into some future episodes, because we're going to go into a deeper dive and probably use the whole episode to talk about it and give you examples and show what we like to do. So please tune in to a later episode.
Yeah, absolutely. So one question we're often asked by our clients as you're looking at these things is, well, which one's your favorite and why don't we just do that?
Right.
And when you see some of these yields, like the distressed debt and opportunity fund we run has great yields, but it's not the answer. The answer is diversification. So we're not saying to do real estate lending solely. We're not saying to use bonds or to use index strategies. We're saying to use all of them in the proper mix based on your risk tolerance, your time horizon. Proper portfolios, you don't want to marry one strategy. You need diversifications because what we call black swan events happen. And the pandemic we just lived through, that was a black swan event. Real estate is great, but what is the black swan event that could happen to real estate? So Great Depression was devastating on all asset classes, just about, including real estate. So diversification helps protect you. And that's how we do a fixed income portfolio is we have the proper mix based on your goals and risk tolerance. And that's how you should create your portfolio if you're putting together a fixed income portfolio. Diversify.
All right. Well, Terry, obviously, I'm sure you're going to get lots of questions. People want to learn more about this. How do they reach you?
So just visit our website. It's www.weriaadvisors.com, or reach out to us. We always appreciate telephone calls at 916-325-0130. Or just Google us. You can find us around, and we're happy to talk to you, and anything we can do to help, we're here for you.
And of course, everyone, follow this podcast to know when the next episode is ready for you and share with others. Thanks for being with us.
Thanks, Patrice. Thanks, Matt.
Patrice, thank you, Terry.
Thank you for listening to We Money Talk with Terry Wheeler. Be sure to click the follow button to be notified as new episodes become available.